All right, so through many in-depth sessions and several dozen drills so far, you've learned how to analyze the markets, you've learned how to understand them deeply, you've learned how they work, why they work, and how to build a contextual way of looking at them and of analyzing the odds of certain moves playing out. You've also learned about the important areas to take note of and the ones that really drive the future direction of the market. This is all great stuff, and it's going to serve as a very, very solid foundation for building a top notch strategy with tactics that give you an overall edge. But now, what we get to is that last word I said, which is edge. Over the next several sessions, you're going to learn some of the most important concepts about trading. This is the stuff that can make it or break it for you as a trader. And to kick it off, I want to start with an interactive exercise for you to get your hands on this, literally physically, experience what it's like, and then the insights that you get will then take later on throughout the sessions and build on them in the world of trading. So let's start with an exercise. We're going to do a coin flip experiment, all right? So grab a coin. Any coin will do. If you don't have one, pause this video right now, go find one. This is important that you do it. Don't just listen to this. Really, it's really going to help you to actually experience it for yourself. It'll drive home some really important concepts. And once you have that coin, I want you to do just a little experiment with it. Okay? I want you to simply take that coin and flip it 10 times, right? And each time record what you got, whether it was heads or tails, which side of the coin it was. Just record that on a little notebook or wherever you want, a notepad on your computer, doesn't matter. So go ahead and take that coin, do it, pause this video, and then come back when you're done once you've recorded all the results. Okay, so I hope you took the time to actually do the experiment. Because now I want to ask you something. When you were flipping the coin, did you know on any given coin flip, on any specific one, did you know whether you were going to get heads or tails in advance before you actually flipped it? Now, if you did, well, you're a fortune teller and you're going to become a billionaire in the market. But seriously, of course you didn't, right? So keep that in mind, right? Keep that in mind because we're going to get back to it later. Now, the next question is, what did you get? How many heads and how many tails? Now, for you, it could be anything. It could have been, 5 heads and 5 tails, right? Or it could have been, 9 heads and 1 tail. Or in an extreme scenario, it could have been 10 of one and 0 of the other. Any of these things are possible. Now, 10 heads and 0 tails is very unlikely, but probabilistically speaking, it's still possible. But here's the thing. If I were to tell you, take this coin and flip it 1,000,000 times, all right, not 10 times, but 1,000,000 times, just sit there for 10 years and just keep flipping that coin. By the end of it, okay, it's very likely that the total result you'll get will be something around 500,000 heads and 500,000 tails, give or take a few thousand. So it'll be very close to that 50-50. But when you were flipping it only 10 times, it could have been 80% one or 90% one and 10% the other, right? So if you know about probability, if you've studied this stuff, this is just showing the law of large numbers. That when you're using small numbers, right, like 10 coin flips, there can be great variance in the results. But the bigger and bigger and bigger the number gets, the more the results line up with the real probability, which in the case of a coin flip is 50-50, right? Now, in both scenarios, in the small amount of coin flips and in the large amount of coin flips, right? In both scenarios, you never know on any given coin flip what it's going to end up being. But when you have a large amount of coin flips, you know with pretty good certainty, with very, very high odds, that the final distribution between the heads and tails is going to be very close to 50-50. So on the one hand, we have luck, right? This concept of luck, that on any given flip, we don't really know what it's going to be. It's just luck, right? On the other hand, once we get into all the large numbers, luck somehow disappears. Now, the actual probabilities of whatever you're doing just play out, right? So if the probabilities of a coin flip are 50-50, if you do a million flips, you're not going to get unlucky and get 800,000 heads when you wanted tails. That the odds of that happening are probably 1 in a trillion. All right? So over the big picture, over the long term, over doing many of these, luck of any specific one kind of evens out, and you're left with the long-term probabilities of whatever you're doing. Whereas in the short term, yes, luck plays a big part. You could be unlucky and you could, flip 10 heads when you wanted tails on the short term. Big picture, luck evens out and you're left with whatever the actual probability distribution of whatever you're doing is. In the case of a coin flip, it's 50-50. In the case of dice, let's say you want to roll a 6, right? Well, the chances of that happening are 1 in 6, so it's about 16.66%. Now, if you were rolling the die, 10 times, you could get very unlucky, and despite having that 16.67% chance of rolling it, if you roll it 10 or 20 times, you might not roll it any times, right? So you would be unlucky. But if you roll this thing a million times, right, you're very, very likely you're going to have somewhere around 166,000 sixes that you roll. Now, why am I talking about all this? Why does this matter to trading? Why it matters is that most people, right, even most aspiring traders, don't really understand probability and don't really understand luck. They don't understand how to trade for the long term and let the probability distributions work themselves out versus trying to be right on any specific trade. So funny as it may be, it turns out in trading, if you're trying to be right on any specific trade, what you're really doing, it's like trying to call heads or tails in a specific toss of the coin, or trying to roll a 6. Well, you can't do that. You can't predict that. You go, okay, so if the result of any single trade is luck, right? You can't really predict if any single trade is going to be a winner or a loser, no matter what you think the market's going to do, no matter how good you're analyzing it. Well, then, isn't it luck overall? Well, now relate it back to the law of large numbers, right? If you're good enough at analyzing the market, and you have the right strategy, and you have the right techniques, and you have the right money management, and all of that that we're going to get into. If you have that all in place, right? Let's assume now the odds of you getting a winning trade is 60%. So anytime you take a trade, on this specific trade, you don't know if it's going to be a winner or a loser. So that is luck, right? But is it luck that you're going to win over the long term? No. Well, think about it. Now, if you do a million trades, you're probably going to have about 600,000 of them that win and 400,000 that lose. Overall, you're going to be a winner. Even though the result of any specific trade, just like in the coin flip, is luck. And this is what most people somehow fail to understand, is that luck can be huge in the short term and yet be almost zero in the long term. Okay? And, before we get too deep into this now, what is one industry that really just takes advantage of this idea of large numbers and equalizing or getting rid of luck in the long term? Well, casinos. You know, we all know casinos. Some love them, some hate them. I'm particularly not very fond of them at all. See, casinos, what they do is they have the game rigged in their favor. All right, the way casinos make money, think about it. On any given whatever game, let's assume you're playing roulette, right? On any given roll that the casino makes, they could lose money. And they could lose big money depending on how the people bet. If it lands on 17 black and some big high roller had just put $1 million on 17 black, well, they're going to lose a hell of a lot of money on that one. And so that seems just like luck, like they're running their whole business on luck. But in reality, the game is rigged to have something like 52% or 51% odds in the favor of the casino, right? And just like all the other games, each game has its own odds, but usually there's like a 1 or 2% edge in the favor of the casino. So over a large number of players and games, what's going to happen? The law of large numbers is going to take hold, right? And even though the casino might lose on any specific game, on any specific day for that matter, overall, the probabilities will work themselves out and they'll make money. So as a trader, you really have to keep this stuff in mind, right? And start thinking kind of like a casino. You want to be the casino. You want to put the edge in your favor, not care about short-term results, and focus on the big picture of doing the right things over and over and over, and eventually making the money. Now, this is one side of it, which is a side of almost what we're talking about here is pretty much accuracy of, like 50% versus 60%, right? Kind of like related to the accuracy of your trades. How accurate are you? 60% of the time you win, or 70% of the time you win, or 40%, whatever it may be, right? So now let's look at the other side of it, which is the reward to risk. So let's jump right into it with another coin flip experiment, a more interesting one this time. Okay, so for this coin flip experiment, you're going to do a little something more. What I want you to do is take one side of the coin, heads or tails, or, if you're in another country that doesn't have heads or tails, whatever, just choose one side of the coin and assign that side the value of +5. Okay, +5. And the other side of the coin, assign it the value of -1. Okay, so you have one side is +5, and the other side has a value of -1. Now what I want you to do is repeat the 10 flip experiment. Flip it 10 times, okay, and record, each time what you got. But this time, beside what you got, whether it was heads or tails or whichever side you got, write down the value that corresponds to it. So if you got let's say your heads is +5. So if you got a heads, put +5 to it. Then the next flip is a tail, put -1 beside it. And once you have your 10 flips done all together, I want you to add up whatever number you got. Okay, add the +5, -1, +5, -1, -1, -1, whatever it is. Add them all up and figure out what the total is. And so go ahead, pause the video, do that right now, and then we'll discuss the meaning of all this. Okay, so once again, I hope you've really taken time to do this, because it just helps when you actually try something yourself and you feel it. Later we're going to be coming back to these, and these things are just going to drive the point home deeper for you. Okay? Now, what did you find was your total? Right? Unless you happen to just been extremely unlucky in the short term and flipped either 9 or 10 of the -1, okay? Unless that happened, very likely, you ended up with a total positive number. So if you just got a normal kind of 50-50 distribution, you got 5 heads and 5 tails, right? Your total is going to be 20. You're going to get 5 times 5 is 25, plus 5 times -1 equals -5, which is 20, right? So that'll be your total. Now, what does this thing show you? Why is this important? Well, what it shows you is that edge, right, can be arrived at in basically two different ways, and it lies on a continuum. All right, on one side we have accuracy, like we were talking about in the first coin flip example. But it's not all about accuracy. On the other side of the continuum, there is reward to risk. And think of the plus 5 minus 1 example we just did. All right? And think of the plus 5 as the reward for one winning trade. And think of minus 1 as the risk or the loss of one losing trade. So now, even if you got only 2 winning coin flips, all right, even if you got only 2 plus 5s, 2 times 5 is 10, and you got 8 minus 1s, so 10 minus 8 is plus 2, right? Even though you only got 2 winning flips, if this plus 5 was dollars, plus $5, and minus 1 was minus $1, you still made money. So the accuracy was against you, and yet the edge was still in your favor. Now, assuming this was a rigged coin, right? A coin that only flips on average to the plus 5 side 2 times out of 10, right? So the accuracy of this particular game is only 20%. Well, even if that were the case, if you flip this thing a million times, right, you would get 200,000 times the plus $5, which gives you $1,000,000, and you'd get about 800,000 times the minus $1. So you would still end up with plus $200,000 if you played this game, despite it having such bad accuracy. Why? Because the reward on the winners is much larger than the loss on the losers. And so this is the other side of the continuum, right? On one side you have accuracy, and the other side you have reward to risk. And there is an unlimited number of combinations of accuracy and reward to risk that you can use to create an edge in trading, right? In trading, it turns out that even if you were only accurate 30% of the time, let's say, only 30% of the time when you take a trade, you make money. The other 70% of the time you lose. You could still be a very consistent, very profitable trader. How? Well, think of the coin flip we just did, right? Think of each time you make a winning trade, you make $500, and each time you lose, because you limit your losses, you lose $100. Okay? So even though you're only winning 30% of the time, think about it. When you do 100 trades, on average, you're going to get 30 winners times $500, that's $15,000, right? Minus 70 losers times $100 a loser, that's minus $7,000. And you're going to end up with $8,000 over these 100 trades, despite only being accurate 30% of the time. Or you can be on the other flip side. You can be accurate 70% of the time, right? And you win and lose the same amount. Your winners are $100, your losers are $100. And over 100 trades, you're going to have 70 winners times 100, 7,000. Minus 30 losers times 100, 3,000, and you're up $4,000. So it can work any number of different ways. But the key thing is that it's a combination of accuracy and reward to risk. That is the point we're trying to drive home. Those combine to give you edge. Edge, in turn, is what is the expectation for how much you'll make on average in the long term over a large number of trades. Or if you're playing a game over a large number of coin flips, whatever it may be. That is what edge is. You want the edge to be in your favor in whatever combination of accuracy and reward to risk. In the coin flip, with the plus 5 and minus 1, right? It was definitely in your favor because coin flip's actual accuracy over the long run is 50-50. And if on 50% of the time you're winning $5 or the other 50% you're losing $1, you're going to make a lot of money if you keep flipping that thing. Well, it's the same thing with trading. If you can create a strategy that either wins a lot more of the time than it loses, a higher percentage of the time, or when it wins a much bigger amount than when it loses, or some combination thereof, that is when you get an edge. An edge is the first thing you need, right? The first thing you need before you can be a profitable trader. Because get this wrong, i.e., trade without an edge, and it doesn't matter how amazing your psychology is, and it doesn't matter all the analysis you do, you're going to lose money. The probabilities will guarantee it. It's that simple. Most traders out there, all right, are trading with strategies that don't have an edge. They don't really understand the markets. They definitely don't understand how to read them in a contextual manner like we've been teaching for the last many sessions. And so overall, they end up not having an edge. And then they're told by the gurus out there that all you need is great psychology and the most simple stuff can work. Well, simple stuff can work. It doesn't have to be complicated in principle. But you have to develop the complex contextual way of putting that simple stuff to work, right? That's the key. And that's what gives you the edge. And once you have the edge, then you can apply great psychology, to not deteriorate that edge. And that's how you make money in the long run. You become the casino. So this is the most important stuff. And in the next few sessions, we're going to be getting into a real understanding how they really work from a practical basis in trading. And we'll be giving you some tools so you can input your own values, experiment, and see how all this stuff actually works in the real world of trading. But for now, the main things you have to remember are that understanding basic probabilities is key to understanding edge. You have to understand the law of large numbers. You have to understand this issue of luck in the short term that kind of cancels out in the long term. You have to really keep these things in mind. And you have to understand that edge is key to becoming a consistently profitable trader. Without it, you can have the greatest psychology in the world, and you could have a massive trading account, and you're going to lose money. So keep this stuff in mind. I hope the exercises kind of drove home some of these points for you at a more internal level, because now we're going to get into the fun stuff and get into some spreadsheets, actually input numbers, show you how it all works in trading, and then allow you to do it yourself. So it really drives the point home. So we'll get started with that in the next session.